All right, let's get right into it. Today, we're not just looking at a stock. We are going to deconstruct an entire investment thesis from the ground up. We're going to walk through exactly how professional analysts dig through the data to find those opportunities that, well, the rest of the market is completely missing. Think of this as a masterclass in seeing what isn't immediately obvious.
But let me start by asking you a question. What do you do when you see a company that's just fundamentally solid? You know, a business that's doing everything right, but its stock price is telling a totally different, much darker story. This isn't some hypothetical question, folks. It's the central puzzle we're about to solve today.
And here is that puzzle, laid out plain and simple. On one side of the scale, you've got strong, consistent, growing performance from the company, but on the other side, a stock valuation that's been falling. I mean, it's a direct contradiction. And it's inside these contradictions where the real value investors go hunting for opportunity.
So, how in the world does an analyst make sense of this? Well, they give it a name. And that brings us to the core idea of this entire analysis, the value divergence thesis. Let's break down exactly what that means.
Here's the answer right up front. The research note doesn't beat around the bush. It says, flat out, that VICI Properties is a textbook example of value divergence. The actual value of the company and the market price of its stock have split apart. Everything else we're about to look at is just the evidence to prove that one powerful statement.
Now, the technical term for what's happening here is PE multiple compression. And don't worry, it's a really simple but absolutely crucial concept. The E in the PE ratio, the earnings, that's going up. But the P, the stock price, it just isn't following. So what happens when you divide a stagnant price by growing earnings? The result, that PE ratio, it gets smaller and smaller. The company becomes cheaper relative to its actual profits.
And I love this analogy. This is how the analyst sees this situation. They call it a coiled spring. All of that fundamental strength, all those growing profits, they're building up potential energy. The stock price is what's holding it down for now. But if the market ever wakes up and recognizes the true value, that spring could uncoil, and fast.
Okay, so talk is cheap. Let's follow the data trail. In this section, we're going to look at the hard numbers behind both sides of the split, the rising performance and the falling price.
Let's start with the good news, the performance side of the story. The data here is simple, but it's really powerful. The company's trailing 12-month earnings per share, or EPS, it grew from $2.15 to an estimated $2.39. The report even calls this monotonic growth, which is just a fancy way of saying it's a steady, predictable climb. The business is fundamentally healthy, no question about it.
So here's the kicker. The company's financial engine was running smoothly, getting stronger even. But the market? For whatever reason, it was not impressed. In fact, it started valuing those growing earnings less and less. Let's actually visualize that disconnect.
This chart, this is the heart of the entire thesis. Just look at the blue line. That's VCI's PE ratio. It's in a clear, undeniable downtrend. Now look at the gray line. That's the S&P 500. And the yellow line, the broader real estate sector. They're both going up. The rest of the market is getting more expensive, but VCI is getting cheaper. This is the value divergence, right here in living color.
And this is just how cheap it got. By November of 2025, the market was only willing to pay 10.6 times VICI's annual earnings for one share of its stock. To an analyst, a number this low, especially for a company with stable, growing earnings, just flashes like a giant neon sign.
Now let's put that number in context, because that's where it gets really wild. This slide just makes the comparison incredibly stark. VCI is trading at a PE of around 11. The average company in the S&P 500? Almost 3 times more expensive, at 31 times earnings. And even within its own sector, real estate, VCI is a deep, deep bargain compared to the average of 32.
You know, spotting an opportunity is one thing, but actually acting on it, that's another story. A professional analysis is pretty much useless without a clear plan. So let's see how this insight gets turned into a concrete, disciplined strategy.
So the analyst lays out this very clear 3-step plan. It's not just go buy it, it's a whole process. How to get in, how to confirm the thesis is actually working, and most importantly, how to protect yourself if you're wrong. This is what separates professional investing from just speculating.
Okay, step 1, act now, but don't go all in. The recommendation is to start a half position, 50% right away. And why? Well, you want to lock in that deep value PE of 10.6. And just as important, you get to start collecting that impressive 6.5% dividend while you wait for the market to catch up.
Now, this is the really prudent part of the plan. You don't commit the rest of your cash until you see proof that other investors are starting to see what you see. The analyst is waiting for a very specific technical signal, a momentum crossover, that suggests the risk of this being a value trap is fading and the stock is finally starting to move.
And finally, maybe the most important step for any investor, risk management. The analyst defines the exact point where the thesis is proven wrong. If the stock falls to $25, something has fundamentally changed, and the plan is to get out, to exit the position and preserve your capital. This isn't about hope, it's about discipline.
So, if we zoom out from the specifics of this one company, what are the timeless principles we can take away from this? What are the lessons we can apply to our own investing?
Here are the big takeaways. First, you have to actively look for these splits between a company's health and its stock's price. Second, let the data, things like earnings and PE ratios, be your guide, not market chatter and hype. Third, a real strategy isn't just an entry point. It has rules for confirmation and, crucially, for getting out. And finally, always remember this. A great company doesn't always mean it's a great stock at its current price, and a struggling stock doesn't always mean it's a bad company.
We've just deconstructed one investment thesis that was based on a clear market puzzle. And that leaves us with a final and, I think, empowering question. Now that you know what to look for, what other puzzles, what other gaps between price and value are out there right now just waiting for someone like you to solve them?